Welcome to Real Estate School. Today, we'll be discussing another topic that you need to understand to pass your state's real estate licensing exam. Today, we'll be discussing types of leases. Also, be sure to stay to the end because we'll have some good exam prep questions for you. So let's get started. A lease can be characterized by the manner in which rent payments are determined, as well as the type of property being leased. Gross lease. A gross lease, or full-service lease, requires the landlord to pay the property's operating expenses, including taxes, insurance, repairs, maintenance, and maybe some utilities, while the tenant pays only rent. Rent levels under a gross lease are higher than under a net lease, since the landlord recoups expense outlays in the form of added rent. Gross leases are common for office and industrial properties. Residential leases are usually gross leases, with the exception that the tenant often pays utility expenses. Net lease. In a net lease, the tenant pays all or most of the property expenses, in addition to the monthly rent. This is also referred to as a triple net lease. The tenant pays multiple line items of rent. There could be a monthly rent charge, say $1,000. In addition, the tenant could also be paying CAM charges. CAM stands for Common Area Maintenance. Let's say that you're renting a store in a shopping center. The idea here is this is the cost to maintain the shopping center for the year. Cut the grass, put mulch down, fresh flowers in the springtime. Common area maintenance divided by the overall square footage of the shopping center, multiplied by the square footage of your unit. Divide that number by 12 and add that to your monthly rent. So let's say $175 for CAM charges. Another fee a tenant could be paying under a net lease could be property taxes. The same idea. The property taxes for the entire shopping center for the year, divided by its overall square footage, multiplied by the square footage of your unit, divided by 12, and add that to the monthly rent. Let's say the property taxes are $125. This tenant is paying a total of $1,300 a month. The rent paid to the landlord is net income after operating costs have already been paid. Net leases are common for office and industrial properties. They are sometimes also used for single-family dwellings. In practice, the terms net and gross lease can be misleading. Some gross leases still require tenants to pay some expenses such as utilities and repairs. Similarly, some net leases require the landlord to pay certain expenses. Prudent tenants and landlords look at all expense obligations in relation to the level of rent to be charged. Gross leases or net leases may also be a percentage lease. This would be typical if you're going to rent a store in a mall. The mall says, we're bringing in the clients. They're coming in shopping in your store because they're coming to our mall. And since we're bringing you your customers, you owe us a percentage of your sales. A percentage lease allows the landlord to share in the income generated from the use of the property. A tenant pays percentage rent or an amount of rent equal to a percentage of the tenant's periodic gross sales. The percentage may be a fixed percent of gross revenue with a minimum rent, a fixed minimum rent plus an additional percent of gross sales, a percentage of rent or minimum rent, whichever is greater. Percentage leases are generally for retail properties. Residential lease. A residential lease may be a net lease or a gross lease. Usually it's a form of a gross lease in which the landlord pays all property expenses except the tenant's utilities and water. Since residential leases tend to be short in term, tenants cannot be expected to pay for major repairs and improvements. The landlord rather absorbs these expenses and recoups the outlays through higher rent. Residential leases differ from commercial and other type of leases in that lease terms are shorter, typically 1 or 2 years. Lease clauses are fairly standard from one property to the next in order to reflect compliance with local landlord-tenant relation laws. Lease clauses are generally not negotiable, particularly in large apartment complexes where owners want uniform leases for all residents. Lease purchase. A lease purchase is used when a tenant wants to purchase the property but is not yet able to do so. Perhaps the tenant cannot obtain favorable financing or clear title, or the tax consequences of a purchase are currently unfavorable. The terms of the sale are negotiated and agreed to at the same time that the lease is signed. A down payment is paid, which may or may not be refundable, and part of the periodic rent may be applied toward the purchase price of the property. Both parties hope that by the time the lease expires, the tenant's issues have been resolved and financing can be obtained, or the tenant can purchase the property outright. Commercial lease. A commercial lease may be a net, gross, or percentage lease if the tenant is a retail business. As a rule, a commercial lease is a significant and complex business proposition. It may involve hundreds of thousands of dollars for improving the property to the tenant's specifications. Some important features of commercial leases are long-term, ranging from 25, 50, and sometimes up to 100 years. Require tenant improvements to meet particular usage needs. Virtually all lease clauses are negotiable due to the financial magnitude of the transaction. Default can have serious financial consequences. Therefore, lease clauses must express all points of agreement and be very precise. Ground lease. A ground lease, or land lease, concerns the land portion of a real property. The owner grants the tenant a leasehold interest in the land only in exchange for rent. The tenant leases unimproved land, makes improvements to the land, and at the end of the lease period, the structures become the property of the landowner. Ground leases are primarily used in 3 circumstances. An owner wishes to lease raw land to an agriculture or mining interest. Unimproved property is to be developed, and either the owner wants to retain ownership of the land, or the developer or future users of the property do not want to own the land. The owner of an improved property wishes to sell an interest in the improvements while retaining ownership in the underlying land. In the latter 2 instances, a ground lease offers owners, developers, and users various financing, appreciation, and tax advantages. For example, a ground lease lessor can take advantage of the increase in value of the land due to the improvements developed on it, without incurring the risk of developing and owning the improvements. Land leases executed for the purpose of development or to segregate ownership of land from ownership of improvements are inherently long-term leases, often ranging from 30 to 50 years. Proprietary lease. A proprietary lease conveys a leasehold interest to an owner of a cooperative. The proprietary lease does not stipulate rent, as the rent is equal to the owner's share of the periodic expenses of the entire cooperative. The term of the lease is likewise unspecific, as it coincides with the ownership period of a cooperative tenant. When an interest is sold, the proprietary lease for the seller's unit is assigned to the new buyer. Variable lease, meaning the rent can vary. A lease may allow for increases in the rental charges during the lease term. Two types of variable leases. A graduated lease provides for specified rent increases at set future dates. An index lease allows rent to be increased or decreased periodically based on changes in the consumer price index or some other indicator. Sale and lease back. In a sale and lease back, the property owners sell the property and then lease it back for an agreed period and rental. The original owners pull out their equity to use on other projects and are also able to reduce their taxable income when they pay rent to the new owner. The new owner has a reliable source of rental income for an extended time. Leasing of rights. The practice of leasing property rights, other than the right to exclusive occupancy and possession, occurs most commonly in the leasing of water rights, air rights, and mineral rights. For example, an owner of land that has deposits of coal might lease the mineral rights to a mining company, giving the mining company the limited right to extract the coal. The right lease may be very specific, stating how much of a mineral or other resource may be extracted, how the rights may be exercised, for what period of time, and on what portions of the property. The lessee's rights do not include commonly sold interests such as occupancy exclusion, quiet enjoyment, or possession of the leased premises. Another example of rights lease is where a railroad wants to erect a bridge over a thoroughfare owned by a municipality. The railroad must obtain an air rights agreement of some kind, whether it be an easement, a purchase, or a lease, before it can construct the bridge. So now that we've discussed lease types and lease terms, let's ask you some practice questions. Question number 1. Which transaction is best described as involving a ground lease? A. A landowner agrees to let a tenant drill for oil on a property for 75 years. B. The tenant agrees to pay a proportionate increased rental based on annual appraisals of the rented property. C. A landlord charges a commercial tenant separate amounts for the land and for the leased building. D. The tenant pays a base amount for the property plus a percentage of the business-generated income. The answer is C. A landlord charges a commercial tenant separate amounts for the rented land and for the leased building. When a tenant has separate leases and pays separate rents on the building and the ground under it, the second agreement is a ground lease. The consideration paid for it is the ground rent. Question number 2. A tenant enters into a commercial lease that requires a monthly rent of a minimum fixed amount plus an additional amount determined by the tenant's gross receipts exceeding $5,000. This type of lease is called A. A standard lease, B. A gross lease, C. A percentage lease, or D. A net lease. Our answer is C, a percentage lease. When a business tenant pays rent that varies according to the tenant's gross business receipts, the arrangement is called a percentage lease. In such a situation, the landlord shares in the tenant's business risk because of the possibility of receiving no more in rent than a minimum fixed amount. Question number 3. Under the terms of a net lease, a commercial tenant would usually be responsible for paying all of the following property expenses, except A. Mortgage debt service, B. Consideration for the use of real property, C. All monies paid by the lessor to the lessee, and D. The total balance under the terms of the lease. The answer is A. Mortgage debt service or mortgage payment. Under a net lease, the tenant pays all property expenses, including taxes and insurance, utilities, maintenance, and so on, but does not pay debt service, which is the landlord's mortgage payment. Our next question. Which of the following lease types convey rights other than the rights to exclusive use and occupancy of the entire property? A. A rights lease. B. A percentage lease. C. A gross lease. Or D. A net lease. Our answer is a rights lease. Leasing of rights is the practice of leasing property rights other than the right to exclusive occupancy and possession. This type of lease most commonly is used in the leasing of water rights, air rights, and mineral rights. A tenant signs a lease that includes a schedule of rent increases on specific dates over the course of the lease term. What kind of lease has the tenant signed? A. Percentage. B. Net. C. Graduated. Or D. Index lease. And the answer is, just like it sounds, C. Graduated lease. An agreement in which the tenant agrees to pay predicted regular increases during its term is called a graduated lease. And our last question is going to be, which of the following describes a gross lease? A. An agreement in which the tenant pays a fixed rent and some or all the utilities, and the landlord pays all taxes, insurance, and expenses related to the property. B. A lease in which the tenant pays rent plus some or all the operating expenses related to the property. C. A lease in which the tenant pays the landlord a percentage of the monthly income derived from the property. Or D. An agreement allowing the tenant to terminate the lease if certain conditions near the premises become unbearable. The answer is A. An agreement in which the tenant pays a fixed rent and some or all of the utilities, and the landlord pays all taxes, insurance, and other expenses related to the property. In a gross lease, the tenant pays no part of the property's operating expenses other than utilities. Thank you for watching. Hopefully you learned a little bit more about types of leases. Please like and subscribe, and let us know if there's something you'd like to know more about in the comment section. Thank you.